All right, welcome to the Gray Report. I'm your host, Spencer Gray. And if you are a multifamily investor, an aspiring one, or an industry insider, or if you just love creating passive income and generational wealth, well, strap yourself in because we have a heck of a show for you today. We've got Matt Bosnagel and Jay Reeder here with us today. Jay is the Director of Acquisitions and Asset Management here at Gray Capital, and Matt is our Director of Communications and Marketing. You saw Matt on the show last week going through the Gray Report newsletter, and we're doing that today. This is going to be a weekly ongoing series, keeping you up to date, essentially what happened in the world of multifamily, commercial real estate, and the economy this week. And if you do one thing to try to take in some information, if you just listen to this recording, watch the video on YouTube, we are going to keep you up to speed. And of course, by receiving the Gray Report newsletter every Thursday morning, you will stay even further up to speed and get the full article sent to your inbox every Thursday morning. And again, you can sign up for the Gray Report by going to graycapitalllc.com/newsletter. That's graycapitalllc.com/newsletter. All right, well, let's bring Matt and Jay into the conversation. Matt and Jay, thanks for coming on. How are you guys doing today?
Doing well, Spencer. Thanks for having us on today.
Absolutely. How you doing, Matt?
Doing great. Another great week.
Another great week, living the dream. Absolutely. Wish the weather would improve a little bit, but we can only ask for so much. This weekend's supposed to be good. So, okay, we have another great edition of the Gray Report newsletter. Matt, the theme was shifting to action for the multifamily industry. What are we shifting into action to? What's going on? Give us a quick, just a nice intro.
So I have noticed a lot more action in the markets, especially. It still has been a lot of attention from investors and buyers, fewer opportunities. Part of the headline is me maybe trying to speak something into existence, but there has been more multifamily starts, and politically there has been some action that may dampen the action in the multifamily industry. So a lot of things moving this week, and a lot of things that you should keep in mind. Just going forward, for sure.
Awesome. Well, I want to get into all of it, especially on the political front. We had President Biden give his first State of the Union address last night, and a lot of new discussion about a lot of new government spending, new taxes, specifically on capital gains, potentially getting rid of the 1031 exchange, and also increasing the tax rate on carried interest. So all of that affects real estate investors. And so we're going to get into it here in just a minute. First, let's take a look at the snapshot of rates and markets. We've got the 10-year Treasury bumping up to 1.6%. That's up slightly from last week, where we were hovering closer to the 1.5% range. 30-day LIBOR and SOFR essentially have been unchanged over the past 6 months. Again, that shorter maturity notes on the yield curve are staying much lower, as the Fed funds rate is still essentially at zero. 30-day LIBOR coming in at 0.1%, and SOFR is 0.01%. HUD 223F, that is an interest rate charge for certain type of HUD multifamily loans, specifically the 223F program. Gray Capital, we utilize that program quite frequently. We're in a couple of HUD applications. And Jay, do you have anything, I guess, to comment on, what you're seeing going on with HUD? Because again, you're in the middle of a couple of these applications right now. What do you hear from, our lenders? What do they have to say about HUD? Is the process going smoothly? And what have you seen just in that rate environment?
When working with HUD, it's just kind of a product of whatever they're working on at the time. Sometimes they're busy, sometimes they're not. And given all of the traffic that's kind of gone on in the second half of 2020 into the first quarter of 2021, they are busy. There was actually an update to the HUD map guidelines in March. And so because of that, a lot of people had to put in some applications early. And so they've been kind of sifting through those and kind of slowed some of the process down just because of that bottleneck and that kind of important date. As far as the rate goes, we've seen it come down. It was kind of in the 2.6 to 2.7 range in the last few weeks. It has dropped a little bit back down to the 2.5 range. To kind of give that context, kind of the low watermark that we saw during this whole process with the 223F was about 2.15. And it's kind of ebb and flowed, give or take about 50 basis points, but has never really kind of breached that 2.7 range.
Yeah.
Compare that to Fannie Freddie, which were kind of in the mid to high twos last year. As you can see, we have the 2.9 on the Fannie and Freddie. That's kind of where their floating rates are right now. We got a quote about a week, 2 weeks ago on kind of the fixed rates, and those are kind of in the mid 3 range. And so if you're comparing that, you can see about 1% movement in the agencies as opposed to about a 0.5% movement in the HUD 223F. So you can see a little bit less volatility in the HUD rate as opposed to the agencies, but a lot of the agency pricing is kind of based on how much volume they want to absorb at that time. And so if they're too busy, can't absorb it, they're going to keep the rates artificially high. If they need some movement in the market, they're going to move those lower to kind of drive that. Whereas HUD just kind of tries to even that out a little bit more.
Yeah. And they're doing that by, adjusting their spreads a little bit. And, what also there's a big difference, I think, especially even more than, especially last year, when last year the yield curve, it actually inverted for a little bit. And that yield curve now has just it's been widening quite a bit. And so, the fixed rate products, the fixed rate loans, just in general, whether it's Fannie, Freddie, or a, private lender, usually those fixed rate loans are going to be, pegged to that 10-year treasury plus a spread. Whereas the floating rate loans are typically pegged to an index of a shorter maturity bond, previously 30-day LIBOR, now more and more SOFR with some kind of spread over it. And as the Federal Reserve kind of keeps that Fed funds rate essentially at zero, they have a much more control over those shorter term maturity notes. And so that's why the LIBOR and SOFR and, the 1 year treasury, 2 year treasury, they're staying low while the 10-year has been growing. And just to take a look just briefly at that, the spread between, the 10-year treasury and the 2 year treasury. So this isn't even necessarily the 10-year and the 30-day notes, really just looking at the 10s minus 2s. You can see back here in 2019 that we actually inverted. This is where people were really starting to talk about recessions, and we kind of kept cruising down this line. Eventually inverted back in 2019, back in August, and then really we had the pandemic, and we've seen that expansion over the past really 2 months, and we've come back off it a little bit as rates declined a little bit, but certainly we've seen a lot of yield curve steepening rather than flattening. And which is pretty good to see, because if we go back and look at the past few recessions, we've seen the yield curve invert. Prior to a recession, the gray area is when a recession took place. And then as we were getting out of that recession, the yield curve really starts to steepen as we get into a period of economic growth. That happened back in the dot-com bubble. It happened back in 2008. You see yield curve inverted back in November 2006, again in May 2007. We had the recession in 2008, and then the yield curve steepened as the Fed again lowered the Fed funds rate. They just have less control over the longer dated maturities. And then over the next 10 years, that yield curve eventually declined until we inverted, and now we're on the way up again. So I think that's a relatively positive sign for the economy in general. Okay. Guys, do you have anything else, any other comments based on any of the kind of the rates, market information? We're tracking a lot of different things. We're tracking REITs, we're tracking gold, lumber, steel, oil, all the cryptos. I guess the one thing, do you guys have anything you want to mention or anything of interest?
I think the biggest one that we can always go back to, specifically the commodity that you could tie to multifamily the most, is the cost of lumber. You think of it initially when you think of new construction, when you think of building an apartment complex, and kind of the metric in the multifamily is cost below replacement or cost above replacement. And so that's obviously something you want to keep an eye on, but it's not just the cost of new construction. One of the most valued buzzwords in the multifamily the last 10 years has been value add. Well, the cost of doing a value add is more expensive now as well, not just the cost of putting a new construction in. And so when you look at that over the course of time, the idea of, hey, 5 years ago, put $5,000 a unit into it, and that's all you need to do. Well, $5,000 today doesn't buy me what $5,000 3 years ago did. And so we're not seeing that just on new construction, but the idea of improving properties as well, or even our day-to-day maintenance. One of the big things that we've seen, and it's not a metric that we had on here with construction costs, but even just getting appliances and things like that, it's harder. And because of that, it's more expensive. And so just the day-to-day operations that we go through, we can't say, hey, we're going to run it at $4,000, we're going to run it at $5,000 per unit expenses, because those things have gone up. Now, I don't think we're going to see the same rate of growth on those over the next 2 to 3 years. So it's not like we're going to be writing 5% increases in expenses every year after that. But we have to recalibrate when we're doing our underwriting and looking at deals to understand of what is things done really in the last 12 months, because what it's done in the last 12 months is going to be a much better picture of maybe what it was 2 and 3 years ago. Whereas previously you could say, okay, what's the average of what they've done the last 3 years, and get rid of the high one, get rid of the low one, and kind of somewhere in between. Whereas really right now you're looking at the last 12 months and seeing, okay, how has this property absorbed these costs? Or if I'm doing a rehab, what's the cost of that rehab? Because it's kind of the new normal right now.
Yeah, I think it really is. I think that there's a lot of people trying to play catch up. And I wouldn't just say a lot of people, I would just say just about everybody is trying to play some degree of catch up, trying to figure out, just where are we right now? Because pricing last year, that was last year. We've totally moved on beyond that. We've seen significant prices just across the board, looking at just about any type of asset class, whether it's an investment asset class or a commodity or whatever it is. I mean, just quick to touch on what's going on in the stock market right now. I mean, we've got the S&P 500 looking at the SPY, hitting its all-time high again. Basically opened today at 4,200, 420 on the SPY, and we've come off that a little bit, but all-time highs. And then, when we look at, we like to track some, different types of REITs, if you look at Avalon Bay Communities, this is one of the largest REITs, apartment REITs. They're mostly focused on gateway markets, very high end, primary and gateway markets. So not exactly what we're focused on, but again, looking at the public markets, opinion, market sentiment for real estate assets. I mean, I think there was a major mispricing of apartments, right when the pandemic started. This happened back in March of 2020 when everyone didn't know what was going to happen. And we've seen some very strong recovery, but I still think this is interesting that, they basically have only recovered a little bit more than half of their losses. And so, the market is pricing in continued gains for multifamily, but still hasn't recovered compared to other asset classes, at least in the public market. And I think this is a good example of the advantage of purchasing actual real estate or investing through a syndication or direct versus owning a paper real estate or through a REIT, because our assets certainly didn't get cut in half. If anything, we're seeing 10 to 20% value increases kind of across our portfolio. So it's pretty interesting. And just on that topic, before we really get into the articles, Jay, I want to touch on the multifamily market, kind of where things are, because, the pricing is, it's crazy. I mean, it sort of makes sense, I guess, if we're pricing in a lot of inflation, but like we've discussed, I mean, and Jay, we were talking about earlier this morning, Vic, there was a point, because, we were slightly involved on 2 projects, and then we were co-sponsored 2 other projects, very similar vintage last year. And they were both purchased in 2020. And it's the price difference between, a couple month period where, one went for, about 130 a door. And now all of a sudden the price was kind of in the 140, 150 a door range. And now for similar kind of early 2000s vintage, kind of core plus, very light value add, if any, type of assets, they went from trading at a 6% cap rate down to a 5% or sub 4.75% rate. And that happened over like a 3 to 6 month period. And we have a kind of a recent encounter with just some of the fervor of just needing to get capital deployed with the massive amount of money that is sitting on the sidelines. So we had a deal recently that we lost, but could just kind of tell the kind of a little bit of the story without getting into anybody's name or anything. Kind of what happened with that deal.
Oh yeah, we're pursuing pretty hard a deal kind of in the southeastern United States. I will not call it a gateway market in the southeast, but definitely emerging market. You look at any of the kind of top trended markets in the southeast, this one tends to pop up on a lot of radars. It may not be the shiny jewel, but it has a lot of things going for it. And we'd been in conversations with the broker, had underwritten the deal, and we're finding some really attractive yields on this deal. And found it's very similar to kind of hit all of our metrics. And when we got into the process, we hit initial offers on it. We were right in the same ballpark. I think everyone was within a very, very small margin on initial offers. Everyone came in best and final. This one did have kind of a special circumstance where right before best and final, there was some additional financial upside that came through that made the deal more attractive. But long story short, instead of just going through an initial round and a best and final round, this one ended up going through 3 rounds, went through buyer interviews, and the property sold 10% above whisper price. And like
$5 million over kind of the initial whisper, essentially, or a little bit more actually. And if that was an anomaly, it'd be one thing, but that's happened to us on multiple other deals this year where we thought we were being pretty aggressive. We're like, okay, we're confident in this rent growth, but we're not going to speculate any more than that. And we can't pay any more, but we felt like we were being very aggressive on trying to go after some of these deals. And there are other groups that are way overshooting what we're trying to do. And so it's difficult. It's happened a couple of times. And then I just heard a story earlier today. The same thing happened up near one of our projects up in Northern Indiana, where, it's same story. It went up, $7 million over the whisper price. And, that's just where the market is right now. It's very similar to what's going on in the single family home space, where you see, or you hear about listings going, 25, 50, 100K over ask, just because people need to buy something. Like they're sick of not buying something. They've been thinking about it all 2020. They said, I'm going to hold off, whether it's buying a single family home or an investor buying an apartment building. And then all of a sudden they're like, especially in the multifamily space, I think kind of in probably early fall, everyone was realizing, okay, the floor is not falling out. Rents are rising. The economy is going to be getting white hot here soon. And I've just been sitting on my hands for the past, 6 to 9 months. I've got some FOMO. Let's make some deals happen. And they're just throwing money at it.
And sorry. I think the idea of if they did sit on money last year, a lot of people in syndication firms obviously have to raise money, but it's not just people in syndications. There are institutional investors that have to get returns. And if they sat for 12 months last year and got no returns, they have to get something. It can be less than what they normally get, but they have to get something this year or next year. And so they have to place that money. It's not is it a great investment? Is it a good investment? It's an investment. And so we're seeing the results of that right now.
Yeah. I think that's a good topic that like they need to get allocated. You've got cash, and if cash is trash and the dollar is being debased and devalued, you want to run from cash. And really, a lot of, obviously there's parts of the multifamily investment thesis that we love about it. But really a lot of what we're doing is we're shorting the US dollar. We're allocating ourselves to hard assets that are going to be protected against dollar devaluation. And if you're left holding a significant amount of US dollars when, we have, created trillions of dollars over the past 12 months, that's going to have an impact. And just as what we're going to talk about in a second, we've got additional trillions of dollars on the docket to be created, and that is going to have effect on the value of the currency itself. And then, just on that note, Matt, let's get into the first topic for the newsletter outside of the Rapes and Snapshot. We got government policy and legislation. What's going on? Biden gave his big State of the Union address last night. Announced a big new project, $1.8 trillion in spending for workers, students, and families. What's going on?
So a lot of money, like you said, is is in the planning stages. I didn't mention this in the newsletter, but I do think it is interesting. The currently debated infrastructure package is still being currently debated, and now there's signs that there's another 1.8 trillion plan coming along. So there's plans upon plans that are happening. Even the current plan is not even being executed yet. So it's hard to kind of predict what is going to happen. I also think that a lot of the things that are in this new plan don't seem like they will be passed by the Senate, but I may have more faith in government intransigence than others.
I think that's a good point to mention, is that, these are really opening salvos, and like, these aren't like bills that have been, debated and they're ready to, go to committee. They're not even through committee. They're still very early on. And so, this is kind of the opening draw. And so what actually is going to happen? We all know that between the $2 trillion or the $2+ trillion for infrastructure spending, that's going to get negotiated. Even in Biden's State of the Union address last night, he talked about how, he kind of appreciated Republican throwing out their offer, even though it was only around I think $600 billion or something like that. So it's going to probably land closer to $1 trillion, probably 999 billion.
Yeah. I've heard prominent liberals and conservatives talk about, if you really want to fix roads and bridges, you probably don't need 1.8 trillion. Now, I know that they're using a broader definition of infrastructure, but frankly speaking, you don't need $1.8 trillion to fix what is broadly considered to be actual, physical infrastructure.
Well, and I feel like that's part of their plan when they're rolling out the plan for, the workers, students, and families, where they're going to be, adding, universal pre-K, free community college, some more like child tax credits. I think $1 trillion of it is actual spending, and 800 billion is I'm raising revenue through raising the capital gains. I'm wondering if it's
they're not just inventing money, they're actually raising it.
Oh yeah, well, that's what we're going to talk about here in a second. But what I was saying is that first, when they talk about infrastructure, they were lumping all of this, and they call it social infrastructure and human infrastructure. And I'm wondering, by breaking it into two bills, both with very high price tags, they can basically cut each one in half and still kind of get where they want to go eventually. So it'll be interesting what happens. But on the other side of that, what you were getting to is the prospect of raising taxes. We talked about last week, to looking at raising capital gains taxes on those individuals earning over $1 million, raising it to a much higher rate, it's going to be close to normal regular income tax rates, again, for the highest earners. But also came out of Bloomberg this morning was discussing the idea of eliminating not only the 1031 exchange, but also raising the tax rate, eliminating the loophole for carried interest, which that's important, because that's how most syndicators are making the bulk of their money from the promote. And so what the promote is, it's that 30% in the split. And that promote is also known as carried interest. It's how most private equity firms make their money, regardless of real estate. So hedge funds, private equity firms, real estate syndicators, are making the bulk of our money from carried interest. And so I guess, Jay, Matt, do you feel like that the increase in the tax on carried interest, is that going to have any effect? Are sponsors not going to be motivated? I guess what are your guys' thoughts on that?
I think for me, it's, if you're established in the space, I don't know that it's going to make you leave the space. It might kind of quell some new interest in the space, because a lot of people were looking for real estate. It's like, hey, where can I find some lower tax thresholds? But I think if it's someone who really likes real estate, they're still going to do it. They're still going to be making money. It's not like it's going away. It is an increase, but let's not downplay that at all. But I do believe that it will affect it to some extent, but to what I can say it's actually going to do, that I'm a little bit less sure of, just because it's not going to be enough that someone's going to completely change their business plan if they've been in this industry 5, 10, 20 years. But I also don't know if it's going to cause people to not want to get into the industry as well, because part of getting into the industry was a lot of the advantages of how you earned your money. And will those opportunities exist somewhere else better? Maybe. And if it don't, then I think it's just kind of one of those things where you're going to be taxed whatever industry you're in. And so it's just what you get at.
So Jay, I'm sorry for interrupting you, but so it does seem like you have the capital gains, the potential for capital gains on one hand and the potential for 1031 on the other. Now, I think that whatever was announced will probably be diluted as it comes through Senate and will definitely change form in some way. But how will that, the pressure from the people that are expecting the 1031 changes, what kind of actions are people going to do? And how's that on the other side, the people that are anticipating the capital gains reductions, how are those going to interact in this year? And what's that going to do to the market?
I think the biggest thing is to kind of go back to Spencer's point. I think the carried interest is going to have a lot less effect on the market itself than the 1031 will. The 1031 is going to have significant ramifications. Some people think it's going to be good. Some people think it's going to be bad. Regardless, it's probably going to make it crazy through the rest of 2021 at the very least. The biggest reason for that is there are some people who are concerned whether this tax would go retroactive. They're concerned whether it's going to go in place the day the bill's passed, or if it's going to be January 1st, 2022. I think most people believe it's going to be January 1st, 2022, if and when it does pass. However, what that does is it has a lot of people preparing now for that. And so if you want to get out and you want to make your money, you're going to sell and you're going to have to close by December 31st, 2021. So it's going to create a large volume of properties coming to market so people can realize those gains at the current rate as opposed to deferring those off. Because one thing that wasn't mentioned was there also is an estate component of this as well, where a lot of people were like, you know what, I'm just going to hold on to it. And from then on, I'm going to give it to my heirs. They're going to get a step up in basis and it's not going to be an issue.
Yeah.
It goes away now. And so with that going away, now people are going to be concerned more about the here and now. And so with that, like I said, you're going to have deals coming to market. And so what it's going to do, it's going to be twofold. There's going to be a ton of deals coming to market. The flip side of that is because there's going to be a lot of deals coming to market, people are going to need to place that money somewhere else in some sort of haven to keep it moving from now on.
Yeah, and I'm wondering if I'm curious if people are going to roll it into other real estate deals. If this makes opportunity zones that much more attractive, because that's going to be one of the last kind of havens for capital gains, or if they're just going to roll it into, like we were talking earlier, just a more expensive, nicer asset. So they've got that just that the large they're resetting their basis at that new asset and just understanding what the tax regime is like today, just getting it over and done with. Will be interesting. And then also, so I mean, on one hand, like you said, there should be a flood of deals coming to the market. A lot of properties coming to sale of people trying to lock in what their capital gains, what the rate that they know, and just lock in their gains now before they see their rate increase significantly. And so that's going to increase volume. If that's going to decrease prices, just because there are so many more deals coming on the market. But like we've said, there's so much capital there that just waiting to absorb all that new supply of deals. And so if anything, what I'm hoping is that we get some sort of equilibrium in terms of pricing, if I can say anything, and so we see at least more stability and a plateau in pricing and cap rate compression. Maybe more of like a linear increase in prices rather than exponential, and just a little bit of kind of calming of the market, for a period. But it's going to be it may be calm in terms of, where prices kind of remain with the cap rates, but a lot of people are going to be thinking about making decisions very shortly.
Yeah.
Okay.
And
I
I
just
think
want,
that I think
sorry. I just want to make sure we didn't lose you, Jay.
Yeah, nope, I'm still here. And I think that makes a lot of sense. But on the flip side of that, because people are going to be trying to realize those gains, we all know that property values have gone up 10, 20, 30%, even just the last 2 years. And so
Yeah.
if you have a property that you want to move out of, I kind of did some back of the envelope on if you had a $10 million investment and you had a $30 million or $3 million equity slug of that, which is about 30%, and you had a 7% return, you got about $210,000 a year. To avoid the taxes, you can roll that money into a new deal. And with the 20, 30% increase, you're seeing now you're going to do a deal where you got $5 million at that same 30% equity slug. And to get the same dollar amount, you can take a 40% reduction in your return and still get the same cash and have a higher basis. So that way, when you go to sell that property, your basis is even higher and you're less affected by the capital gains. And so that's one concern that we have in the market is as hot as it's been, if people are just trying to place that 1031 money, we could see it potentially get a little bit hotter on specific deals because people just need to park that money before they realize the tax hit.
Yeah. And so they're just looking at what their nominal return, the kind of the volume of cash versus what their actual return is going to be. I think that makes sense, especially a lot for many owners who have owned property for a long period of time. They're like, look, I've been cash flowing, $1 million, and as long as I get to continue for $1 million in cash flow, that's okay that I'm not getting a 8% cash on cash return. If it's 4%, that's whatever, because I'm still getting my $1 million of cash flow a year. I'll take it. And then the other piece is, and I think this really relates to the syndication space, is because I'm getting back to capital gains increases, 1031 exchange, all of this is, in syndications, while you can do 1031 exchanges, you can do, tenants in common, kind of a TIC structure with a couple of different entities, although it complicates it. It's not very common to do a 1031 in and out of a syndication, but can do it. But most times you don't. But on the reason why that's, okay. And one of the great things about real estate, and I'm happy that they haven't discussed getting rid of, is the amount of depreciation, all of the paper losses, accelerated bonus depreciation, and interest write-offs that you can get, when you purchase a property. All that's accelerated into that first year, being an incredible amount of losses. And so while you're not completely deferring your capital gains amount, you're significantly reducing that amount of income in that same year if you bought a property in the same year that you sold it. So I think that's going to make syndications a little bit more attractive potentially, because, okay, well, yeah, we weren't going to 1031 exchange anyway. It really doesn't change our business model because we weren't going to 1031 exchange, or we don't really advertise because we most likely won't be able to, or won't make sense. But then additionally, getting all of these paper losses, and this comes back to the capital gains, you want to keep your income under $1 million, your stated income. And so if you are, either increasing your income through your job, or you're, buying stocks that are putting off dividends, that's all taxable income, and it's coming in, if you receive, $10,000, $100,000 in income, you're taxed at that additional $100,000 of income. But if you invest in, real estate or in a syndication, usually for the first, 5 to 7 years on your tax document in your K1, you've got a negative number according to for the IRS's point of view of how much income you received. You may have received $100,000 in income from that multifamily or whatever real estate project, but the IRS sees that you actually lost, $20,000. And so that's a way that you really can kind of keep your income under that $1 million threshold. But then kind of tying in the carried interest piece also, that, we have, being a real estate professional and, being an active real estate investor, the amount of losses that we have is just, it's significant. I mean, we have to make a lot of money before we really starting qualifying for income, and especially into the threshold of being close to $1 million. And we'd have to make so much money with our losses to make $1 million. It's pretty hard to see. I mean, hopefully we do. I mean, that's going to be a great thing to do. But, being in real estate still, there's so many advantages still in real estate that even if the 1031 exchange goes away, I think there's still a lot of opportunities.
I think you're right. There are a ton of opportunities in this space. I think what's going to make it interesting is through the end of 2021, as people are trying to realize that, it's just going to make the market very hard to read.
Yeah, and I agree. So I think the bottom line is still more uncertainty for all markets, including the multifamily market going forward, and new changes in tax law are not going to change that. All right, that's a good bookend on that topic. Let's get into some of the national reports that we're looking at. A lot of great, it's kind of end of the quarter, so a lot of shops are putting out their kind of their quarterly reports. And so, Matt, can you kind of just bring us in? Let's maybe look at this apartment list report first, but kind of sum up what were you seeing reading through these handful of research reports from some brokers?
Yeah. So the apartment list report was especially encouraging. Really, you can see in that chart just right there that graph, how rents are really coming up. We're not really seeing any signs of an additional dip or anything. Multifamily is doing very well. Interestingly, I think that that office has a little bit more of a challenge. I don't think office is picking up as much as other sectors, and really the story is that the strong apartment numbers. There is a little bit less inventory than there really should be, but even then, there's some promise here. So it was all basically good news for multifamily, and maybe some challenges for the office market.
Yeah, that's where I read also is, the multifamily, I mean, based on all the fundamentals, we're in full recovery mode in office. I think they're still down, like valuations are down 6% year over year. And on this report, I mean, absorption square feet was negative 38 million right now. So that's significant. But one thing I really thought, I really like this graph from Apartment List is because it's comparing rent growth over the past 2 or 3 years, 17 through 20 and now 21. We all know that the rental market is a cyclical market. We see, leasing activity taking place during spring and summer. And I really like how they illustrated this. They overlapped all these past 3 years to compare to what 2020 looked like. And so, we always see this peak kind of in August. Everyone wants to get into a home kind of before the end of summer, before school starts. And then, it slows down, really hits a trough in December every year and slowly starts picking up. But last year, we kind of missed out on that nice spring and summer leasing season, at least nationally. I mean, we still saw it in the markets we're in Indianapolis, some other Midwestern markets, but we saw declines instead of increases at kind of this time last year. You still see in August, there were people moving, looking for apartments to rent. Things were still happening, but on a nationwide basis, we still were at slightly negative rent growth. But all of that demand is now being pushed forward, and we are really seeing it materialize really since January. We really saw, and again, this is a nationwide survey, so it's not exactly what we're seeing in our markets, but you see this huge run up and almost a parabolic line for rental increases. And we're seeing a lot of forecasts kind of in the 5 to 10% rent increase projections for this year, depending on the market. So, I mean, things are going, very, very steadily. And you can see, so this is a chart of a lot of the primary markets, the hardest hit markets. And they're saying they have all started to recover, not fully recovered, but they're on the upswing. They hit the trough back here in December, and they are moving back up. So that's always.
Yeah. Also, I thought another good report, and I kind of referenced this as well, was the report on commercial sales from NIR. And it really does talk about how these they mentioned the year over year change of sales prices of commercial acquisitions, and for acquisitions below 2.5 million now, the office class A is down, office class B and C is down, and actually freestanding retail and senior housing those are all up. Land, industrial warehouses, flex industry, apartments, and so there are some retail that are performing better than offices. I think that it really speaks to this story that we've been hearing about people's changing work habits. And it seems like people are much more willing to go back to the store than they are to go back to the workplace.
Yeah.
If I can be pithy.
Yeah, no, I think that makes sense. I mean, between restaurant, there's just some retail that like, and again, we talked about this last week, but like the nail salon, the barber shop, like you can't get that on Amazon. And then restaurants, I mean, the past few restaurants I've been have been slammed. Everyone wants to go out and eat. They're sick of staying inside. And then now that everyone's, not everyone, but a lot of people are vaccinated, it makes that, comfort level much more reasonable. And, sort of on a related but unrelated note, I guess the restaurant industry is having a hard time hiring employees. A lot of, they had to let their staffs, go, reduce their staffs. They went out and found permanent jobs, places that were hiring, and they don't want to work in the service industry anymore because they've got a more steady job. And so, what we haven't seen yet, but which we're likely to see, is they're going to have to increase the wages for these service industry jobs, probably also in the hospitality sector. And, if you listen to it, most economists, they'll say the question of inflation and how much inflation is very much in the air until we see wages really being pushed. As wages increase, that's like the last thing that's really going to set inflation off, because everybody has to raise. If you have to start, the last thing employers want to do is pay their people more because they think they can control that. But when they have to, they're going to then they want to see similar profit margins. So they're going to, raise the prices on the consumer. And not to get back to kind of going backwards and kind of talking about taxes, but, raise capital gains, get carried interest, 1031 exchange. These are all measures that are all just political headlines, and that are going to, it appears that we are taxing the rich to, pay for the poor and the middle class. But what they don't tell you is that these tax increases are relatively marginal. The most wealthy are going to find ways around them anyway. You're not raising that much revenue. So the whole goal of we have to pay for all this stuff is not, they're not paying for it. And the way that they are going to try to pay for it is through inflation and further debasement of the currency through inflation, because inflation destroys debt, because, the value of that debt is denominated in the dollar. And so if you destroy the dollar, that debt goes away. And that's why we invest in apartments. We're putting debt on these properties, and we're letting inflation just destroy the debt and increase the value. And the federal government's doing the exact same thing, but they're trying to say, well, also we want to tax these people because politically that's going to get us some brownie points. And, it's also a form of kind of social engineering and central planning. And
again, and it factors into this decision that multifamily investors and buyers are being forced to make is, did that person that overbid by 10%, are they crazy? Or is it a good decision? Are they really, do they know something? Because it seems like all these forces are converging, and prices that may have totally not made sense last year are making a kind of a crazy sort of sense. I'm not saying that you should way overbid everything, but it is a very overdetermined, there's a lot of factors to this situation. And it doesn't seem like, something's got to give, basically.
And Matt, I don't think you're completely off base with that comment, because on the deal that Spencer and I referenced earlier that we ended up losing, one of the big questions we kept saying to each other is, at what price would 1 year from now, would we be upset if we didn't pay for that deal? Yeah. And that we obviously had numbers to back up where we were, but that was the big decision on kind of where we came in with our final number. Is it's like, okay, we can sell these returns, but we also know that we don't feel like we're missing out on a deal if we choose to not throw the additional 100,000 or throw this. Like, because I'll be honest, there were some deals last year that, looking back, knowing what the market is now, I might have been a bit more aggressive on, but at the time I couldn't justify it, didn't have the means to do it. And we always say in this industry, we don't want to speculate. There is a certain amount of speculation that goes into it, but a lot of that speculation is backed up with hard data. And right now, there's not really hard data to show us where the market's going in the future. And so we kind of have to take a little bit of liberty in trying to figure out where it's going to be. And some situations we may be right, some situations we may be wrong, but we really need to be comfortable that when we put an offer on the table, we're putting an offer that is what we feel that property is worth. And we're not going to be disappointed if we lose the deal because we didn't maybe pay a little bit more, knowing what values could potentially be in the next year.
Yeah. It's always a challenge, and it isn't necessarily new, but really trying to find what that balance is between, being aggressive enough to win the deal, but still sticking to fundamentals, trying to buy as close to actuals, and then to get through, like we do, pretty exhaustive sensitivity tests on these deals, and you try to break our model. And if it's too easy to break and it's kind of flimsy already, we can't get comfortable. And if I can't get comfortable and Jay, you can't get comfortable, there's no way we're going to bring that to our investors, because the last thing that we could do if we do a bad deal, I mean, that totally, screws our business. We can no longer continue to, bring investors on if we're doing bad deals, whereas if we had, all of our own money, if we had, $20 million sitting in the bank and we could just go, drop that money on a deal, there may be some projects that we could say, all right, well, we are willing to speculate on this with our money because, we know it's going to go here, but, that's just too high of a risk profile for, our investors. So it's always a balance of sticking to fundamentals, but at the same time, you have to be where the market is and where it's going. And because I don't know how many, there's a deal in the market now that I looked at, 2.5, 3 years ago, at the time it was, trading for like, $8 million, $8.5 million. And, I was $500,000 away trying to win it and I wasn't close enough. And, I didn't want to overpay at that time. I had my criteria and I was trying to hit. And, now it's on the market 2 years later for $13 million. And so, you win some, you lose some, there's no regrets, but it's going back and saying, it's amazing just the difference in a couple of years. And that's not a unique deal. I mean, I'm an LP in a deal right now that's being marketed. We've only owned it for a little over a year. And, it's, bought it for about $100 a door. And now it's going to go for $140 a door. So, I mean, that's just the reality, but you also can't get caught in this thought process of, stonks always go up, real estate always goes up, rent always goes up. And we saw last year, rent did continue to go up in some markets. It did decline in most markets in the United States, and it declined in the last recession. And so you just can't go up and up and up and up and up and up. There is a ceiling, things have to catch up. And so it's difficult out there, to say the least.
Yeah, it seems like, because of the longer view that you have to take when you're investing in these properties and deals of these size, you have to kind of look at the long term, but almost ignore the immediate term and see see things maybe where things are going to be, not the day after tomorrow, but like, the next year or something like that.
Well, so it's both. I mean, because you got to get your business plan executed in the first, 1 to 2 years. But then, what is the project going to look like over, a 5, 7, 10 year period? And sometimes it makes sense. Okay, well, the safest thing, because we know the real estate, unless like everything changes, the real estate's going to be more valuable in 10 years. Again, unless just like everything changes or there's a major market crash in year 10 or something and everything crashes. And most likely everything's getting taken out if multifamily gets taken out. But, but sometimes it makes more sense to sell. Usually it makes more sense to sell around that kind of that year 5 mark. But you just have to be prepared to kind of hold out a little bit longer. And just if you have the ability to hold on longer, the chance of loss decreases significantly. Because if you look on a sensitivity matrix or a sensitivity analysis of, like kind of break even numbers. It's really, it's in the first 1 to 3 years where, okay, there's a certain price that if you sold it for the price that you bought it at, you're going to lose money because you've got all these other closing costs and you're renovating the project. But after that, year kind of 3, all of a sudden, you're pretty much in the green, and, whether it's a great return, average return, or a bad return, that's kind of up to your business plan and how you execute it in the market. But kind of time is your friend, and using time as an advantage versus having time work against you. Yeah. And that kind of goes to, having the flexibility to hold on for longer, but also, understand kind of what that, in options, you're watching your theta as it's like an option decay, and it's not the same thing, but as time goes on, your return goes down. And because you have that IRR calculation is taking periods into account and the length of holding that money, higher velocity of money, you're going to get an overall higher return. And so there is an optimal point in a project's life cycle, to either to harvest gains in some form, whether that's a refinance or an outright sale. But I don't even know what are we even talking about? How did we get on?
I don't know, but that was interesting. Thank you.
Yeah. Okay. Let's get into talking about, and this all kind of is on the same topic of just prices and of everything, but we're talking about commodities and construction. Again, this kind of continues on to our inflation discussion. We already looked at the price of lumber. It's nuts. But first, let's look at construction. A report from RealPage: multifamily starts surge in March. Matt, bring us up to speed.
Yeah. So there was, and starts are not permits. These are the actual start of construction, which is very promising. They're up about 26.9%, close to 27% since last year, and 30% from February. Permitting was down slightly, but again, the fact that that shovels are metaphorically going into the ground right now is a great sign for the multifamily industry. I know, Spencer, you've talked before about how it's a lot easier to start building single family homes than it is to start building multifamily homes. Or multifamily, properties, but it's nice to see that these numbers are ticking up, especially since, and I did a little bit of reading, a little bit of additional context for the lumber prices. These lumber prices are not expected to go down anytime soon. There are demographic reasons that these lumber producers are expecting just increased prices for a longer time. They say that maybe things might go down around the summer, but it's not like they can start any more lumber mills. That's what I was looking for. I was looking for articles. Well, why doesn't someone just start a lumber business? And that's not viable, I guess.
I'm curious why I guess it isn't, but
yeah.
Sorry, I got stuck when I heard like the shovels in the ground, and I just like
no, it's fine.
I had all these flashbacks, like the shovel ready jobs,
yeah.
Of back in 2009 for the stimulus package that the Obama administration passed, and we've got all these shovel ready jobs, and I'm getting ready, I'm prepping myself for this conversation when the actual debate over infrastructure gets going, of being like, we're going to do all these projects. We've got these shovel ready jobs. And then the argument of saying, well, where are the shovel ready jobs? And then they pass and they spend all the money. And they're like, where are the shovel ready jobs? And it happens, 5 years, 10 years later. But sorry.
Yeah, and that it is worth qualifying. And it is worth qualifying, multifamily starts, these buildings, they're not going to come up overnight. And I'm sure that the higher commodities prices are going to mean that the timelines for these are extended significantly.
Yeah.
In some of these other articles, they talked about, what do you anticipate? Is it going to be 6 months? I think about 21% said at least a 6-month delay. 25% said more than 6 months. And then, a minority said, well, it's not going to be, there's going to be zero, but it'll be delays. Like, so yes, work is starting, but how long is that work going to take is a really big question. And again, someone knows the answer, and I'm gonna do some additional research as to what are the problems in the lumber supply. And I do think that article on the commodities market was interesting because, who is making money off of the rising commodities prices? Well, the people that own the commodities. And I always think of commodities as this indicator.
Well, is that true? So I know that's true to a point, but I've heard it's the sawmill. So the tree farmers aren't making any money, I guess, because a lot of their trees are sold in future contracts.
Okay.
A lot of these long-term agricultural commodities they're all done on forward-looking multi-year contracts. And like there's a smaller spot market. And I know this from in the hops industry. I know it's totally different from the lumber industry, but just things that take a long time to grow. Yeah. You need to be able to like plan of like who you're going to sell it to. But it's the sawmills that are making all the money, and they're the ones that are actually processing and selling them. They're buying the lumber at a fixed, contractual price they signed 4 years ago.
Okay.
And they're the ones that are, because their capacity is limited, they are taking advantage of it. And it's on the starts, when we look at housing starts and multifamily starts, there's the reason why economists track housing starts and construction starts. One, it's a indication of the market sentiment of builders, that they feel like there is demand for houses. But then it's also an indicator of increased economic activity, because you're hiring all these construction workers, you're buying materials, you're buying a lot of stuff, money's moving hands, high velocity of money. And then it's also an indicator of, okay, what kind of supply is coming online? And we have to balance that. Okay, there's a lot of demand, but we want to make sure that's going to be in balance with the actual demand that's out there in each market. And because you can see some markets that are growing really quickly, they have a ton of new supply coming online. And so it's a question of how quickly can that supply be absorbed. And then there's other markets where there's a decent amount of supply coming online, but it's really not enough to really kind of meet the demand. And then that's kind of the markets that I like, is that they're growing. People are building some new construction. It definitely warrants it. There is strong demand, but it's not so white hot that every developer across the United States flies in and builds an apartment. And so all of a sudden you oversupply even a growing market. And it pushes off the amount of time it takes for all those units to be absorbed. So it's all interesting stuff. And I guess anything else on commodities and construction? I feel like we've kind of talked about.
No, but I do want to apologize for completely oversimplifying the lumber supply problem. I know that there's a lot of things that factor into lumber supply, but I do think that
I don't understand lumber supply. I mean, that's just more of what I've heard, and then just what I know about the different types of agricultural commodities, but I don't know anything about lumber. I mean, besides
from the research that I was doing, just the few articles that I did read, it does seem like people are anticipating maybe it will peak soon, or if it hasn't already, and then just a slow, steady decline back to a still elevated level, still elevated relative to even pre-COVID levels. That's what one of these headlines was. It's not going to return to pre-COVID. There's just demographic changes that have happened that have altered demand. That we're not going to get back to where it was, but hopefully it will get to something that's predictable. And that's what we need for investment, is something that we can predict and kind of factor in.
Well, and again, it's not like you can make new widgets. And, one piece of the inflation supply crunch that we haven't mentioned is the semiconductors, because it doesn't really relate as much to real estate, but there's a huge supply crunch in semiconductors right now. And semiconductors, it's a little easier. You can make more semiconductors. I mean, you need the materials, you need the factories, but you can get the materials. You can make, you can theoretically build more factories. Now, like we were talking about, it's hard to build more sawmills, but I'm sure you can. But again, we're talking about trees. You can't just You can't make more trees overnight. You have to when's
the best way? Yeah. When's the best time to grow a tree? 20 years ago. That's what I was thinking when you were talking about when the best time to you said, when's the best time to buy real estate as well? It's last year, But
it's true. It's true. It's those those real assets. So again, this is the chart of lumber, and I more showed this because of yeah, you would imagine we'd get some kind of like correction or like mean reversion. We had one, kind of last year. We saw a huge run up that we thought lumber was crazy, back in September. I mean, everyone was saying lumber was crazy back in September. And I feel like I'm looking at a chart of, Bitcoin or, Dogecoin or something. Because this is nuts. I'm trying to see if I can throw on like a Fibonacci, like retracement indicator. Because we're like, we'll hold off on doing that. But anyway, just the technicals on this growth are absolutely nuts. Okay, Matt, let's quickly get into the final piece of the Gray Report newsletter. We're talking about multifamily trends and technology. I didn't even mean for this segue, but there's a real estate developer out in California. He's accepting Bitcoin for apartment rents. This is something we've talked about. We're looking at accepting cryptocurrencies for our next real estate offering. I've been an investor in cryptocurrencies since back in the day, 2013, 2014. But this is interesting. Kind of give us a little bit of lowdown what's going on out there in California.
Yeah, so Rick Caruso's company, Caruso, is accepting Bitcoin for payments, and I think it's just a little data point. It's not like it's widely adopted, but this, it's a significant development. I think that there is issues with volatility. If someone's making a payment and then the price of Bitcoin starts changing, I don't, what does that mean for the landlord? And then if Bitcoin dramatically increases the day after you make your rent payment, does that mean that you're gonna, that you suddenly are gonna have some regrets? So
yeah, that's the hard part with spending your Bitcoin, is that you can spend it. And that's why there's all types of talk about really using kind of tokenized fiat currency, whether that's like Tether, US, DT, and there's quite a few other fiat currencies that are pegged and tokenized. And then I think it's a good point because, another article that came up this week was, Tesla, when they reported their earnings, I think on Monday, they reported $100 billion of profit from selling some of their Bitcoin that they purchased back in late 2020 or maybe early 2021. No, I think it was early 2021. And because they had made so much off it, and they only sold like a relatively small percentage of it, but it threw $100 million of increased profit to kind of the bottom line. We're seeing more companies adding cryptocurrencies to their balance sheet as opposed to just having cash reserves. And I think all businesses are thinking about that. I mean, we were discussing this kind of at the beginning of the year of, how much corporate reserves should we hold in cryptocurrencies? Not if we should, but how much. And so I think it's a natural progression to have, why wouldn't you accept all kinds of payment options? And I think it's true. Yeah. I mean, the questions are, are you holding on to it? Or are you immediately converting it to fiat, depending on, what your outlook and philosophy is? And then, are you just accepting one type of cryptocurrency? Do you accept everything? And do you peg that to like, you need to pay? I assume that the rent is $2,000 and you need to pay me $2,000 worth of Ether, Bitcoin, whatever. Not the rent is 0.05, BTC or whatever your cryptocurrency is. And that's it. And whatever that equals in dollars. Now, if somebody was a true, hodler, super into crypto, they could set it all their prices in Bitcoin. And again, is this us leading to more of a tokenized economy? Binance has announced that they have tokenized several stocks. They're tokenizing Tesla. They're tokenizing, I think, GameStop, a couple of other meme stocks. So we'll be able to trade stocks, but you're not actually trading the stocks. You're trading a tokenized version of them. And so it's this idea that you're not trading, you used to use dollars to buy in a stock, but they're all denominated in dollars. But now you're going to be using crypto to basically buy stocks, but you're staying in crypto. It's just these stocks are now going to be denominated in cryptocurrencies. And so this is going to lead to the tokenization of other asset classes. And this is something we've talked internally about a lot, of tokenizing real estate offerings and kind of new ways to go about that. Maybe making things a little more simpler, more streamlined. The prospect of smart contracts is very interesting. Can you fit an operating agreement into a smart contract? But we've talked about, obviously, for title, there's a lot of opportunities for the blockchain. But I think we're just seeing this acceleration lose no steam.
Yeah, and that's what my intuition is that as more people are using these cryptocurrencies as something that's not just a store of value, it seems like it seems like it would be the interest of everyone for that volatility to decrease. And I'm not sure if the use itself will create kind of a leveling pressure, or if people will kind of try to search out a lesser volatile cryptocurrency or kind of strategy.
Yep, I think that makes sense. Okay, so let's go on. I'm just moving through the end of the Gray Report newsletter. I thought, there's a couple other articles. One thought that I thought was pretty interesting was this piece on AI versus people in terms of leasing multifamily properties. And a lot of it was, basically, there was a big experiment last year while we're still trying to lease out apartments. I'm utilizing not just, AI leasing and kind of chatbots and basically people self-leasing, but also discussing, self-guided tours and kind of virtual tours versus the demand for people to have a, guided tour, with an actual leasing specialist, with, a manager at the property itself. And, it said that basically, during the pandemic, these virtual tours, they increased in popularity. But as we kind of got out of the pandemic, it kind of flipped, and there was a huge demand for kind of that traditional guided tour. Jay, Matt, I'm curious of your guys' thoughts on this. I mean, I think it's going to be a kind of a combination going forward. I think that the drive for large landlords is the idea that, okay, if I need one leasing specialist instead of two, because my technology can replace, an individual, that's a way to add a lot of value, increase NOI, and reduce expenses for multifamily. But people still kind of want that human touch. And I think when they're being kind of shown around a property, they want to know who works there. And they also mentioned that it was just like out of a desire for any kind of human interaction.
Yeah.
So I don't know how much weight I put on that or not, but what do you guys think?
Well,
I think Jay, you
go take it, Jay.
I think that that's kind of a twofold idea. Going in, having lived in apartments myself, I know that when I'm shopping for apartments, I wanted as little contact as possible. I wanted to do the information I wanted to get the information, so I had my idea of what it was early on. And I think for me, that's one of the things that I've always seen is basically when I was doing my look through at apartments, if they didn't have the price on the website, I didn't even look at it because I did not want to talk to someone just to find out the price.
Yeah.
I did want to talk to someone when I wanted to tour it. Mm-hmm. And I wanted to be sold the property. Once I kind of it hit my bucket, and I'd done all the checks of, okay, is it in my price range? Is it in the location I want? I needed someone to tell me, okay, this is where you want to live. And
yeah,
I think there's something to be said about that. And I know in our industry a lot, we've talked about the right staff makes or breaks a property.
Yep.
And if you move to AI, that argument doesn't exist anymore, but I don't think that it doesn't exist because you're better off. I think you realize very quickly that you need the right people to implement systems. Mm-hmm. And I think you'll always need people on there. You'll always need someone to kind of close the deal, so to speak. And then if you want to automate some of the leasing process, so you don't have to have someone sitting there and walking every person page by page through their lease, I think there's a huge opportunity for that, because once you've sold me the deal and I've made the decision, yeah, send me a PDF, let me sign it on my time. I'm
Yeah.
not going to waste any more of your time. You've got more people you need to talk to. So you're really letting them sell the property and do all of the kind of hands-on things in person, but the technical stuff that you don't need to sit there and watch me read through my lease. Those are the things where I think getting the AI, doing the automated stuff really allows you to make the most efficient use of time.
Yeah. And so I think that's a really good take on it. And it's like many things, it's a combination. It's not like you're totally getting rid of what you've done, but it's really using it as an additive tool. And, do you still need the full staff? Possibly, but, it might be able to make things a little bit more efficient. But I think your description is spot on. Yeah, when you're shopping, just prices, you just want to look at the prices, you want to narrow it down. But then when you're going to make that decision, you do actually want to talk to somebody. And yeah, I think people they like to be sold on something, and it's an indication of, okay, what's this place going to be like? If you can't get me excited to live here after it hits my budget, then maybe I'm just going to keep looking. So I think that's a really good take, Jay.
Yeah, I think that you noted really quickly about how that technology is used too. I think that you have to one thing when you're using these technologies, you have to train people on them and make sure that the way that they are used kind of complements people's skills. People are smart enough to use them, and they continue to use them, because I could see situations where the AI is not someone's not gathering the information or using it correctly, and it screws everything up. So I think it's important to have a system and a technology that is used well, as much as it is just to simply have it.
Yep. All right. Well, if you want to check out any more of these articles, you would have to have been subscribed to the Gray Report newsletter. So if you're not, again, hop on over to graycapitalllc.com/newsletter, where you're going to receive all this information, updated articles, research reports delivered to your inbox every Thursday morning. And the last piece on the Gray Report newsletter that we usually finish them all off are not only our blog posts, which you always have, new blog posts, usually about every 2 weeks. We have an upcoming blog post highlighting Indianapolis and posing the question, and actually we're making the statement, Indianapolis, is it the most underrated multifamily market in the United States? We think so. Check out the blog that's going to be coming out shortly to see why we think that. And, you can hop on over to the Gray Capital blog at any time to see our most recent articles. Our last one was understanding cap rates, interest rate, in the spreads between them. We've got podcast appearances, exploring eviction data, commercial, how to find deals. It's education, it's opinion, it's keeping you up to speed. So if you haven't checked out the Gray Capital blog, I highly recommend that you go and take a look. And then you're obviously watching this recap, but you can go back and watch previous versions of the newsletter from the first time that we did this last week. Hop on over to our YouTube channel. The link is it's on our website. It's also, you can just go to YouTube and search for Gray Capital there. So if you don't have time to read the newsletter itself, or you just want to hear us talk about what's going on for about an hour, well, this is the place to do it. Matt, Jay, I really appreciate you guys coming on the Gray Report today. It was great to get your insight, your opinions, and breaking it all down for me and for all the listeners and viewers of the Gray Report. If you would like to learn more about Gray Capital, you can go over to our website, graycapitalllc.com. You can, again, sign up for this newsletter, join our investment club, learn more about what we do, what we target, our strategy, all that good stuff. And again, if you want to receive investment opportunities from Gray Capital, you have to join our investment club. And as a disclaimer, none of this is investment advice or a solicitation to invest in anything. That would come in the form of a private placement memorandum. And this is all for educational purposes only. So, all right. My name is Spencer Gray. I'm the president of Gray Capital. This has been another great episode of the Gray Report. Have a great day.